Barry Knapp with Ironsides Macroeconomics. Sunday evening, November 28th, the end of the allegedly long Thanksgiving weekend. We wrote a very succinct note this week titled Endemic or Return to the Pandemic. We had every intention of sending out a series of charts. We were likely going to title the note When Doves Fly, as a reference to Mary Daly of the San Francisco Fed, who we consider one of the more dovish Fed governors, in a Reuters interview talking about a real debate to be had about accelerating the taper and how inflation risks were growing. And if the data came in strong between now and December, they would have a very serious discussion about that. Of course, that was all disrupted with the latest COVID variant. And we awoke on Friday morning to an email from CNBC asking us if we could come on and comment on it. You can see that part of that portion of that video on the email that we sent out with this note, that at least that portion of it's available to free and paid subscribers. So here's how we framed that large sell-off that we had on Friday. And the bottom line here is we don't think it'll stick. We do think the market's going to rally. And what we told the audience at CNBC on Friday, and what we wrote in the note that we released shortly after that on Friday, and what I'm going to say to you now is we wouldn't use this as an opportunity to buy tech stocks or the S&P necessarily. We would use it as an opportunity to buy energy stocks, which we had just upgraded the previous week and were performing well until Friday's drubbing, and financials, which are performing, really got hammered on Friday, but we're performing reasonably well last week as rates were moving higher into this Fed debate. Industrials got hit pretty hard, transports, small caps all got hit. So all those sectors, if you're going to use this as a buying opportunity, if you get a window to do so on Monday morning, that's what we would buy. We did send the note out early on Friday to make the point that we wanted you to use Friday's sell-off as an opportunity to take advantage of the reflation theme. So here's how we came to that conclusion. We do not believe there's going to be a significant economic impact in the US from the pandemic, either because of non-pharmaceutical interventions or lockdowns, or because there'll be a significant change in behavior. And one of the ways we would think about those changes in behavior, and you'll see a chart associated with this podcast that will illustrate this point, we really didn't have very much of an economic slowdown in the third quarter. We think that the GDP measure was very misleading. It printed at 2.1% quarter on quarter annualized for the third quarter. When you look at gross domestic income, a measure that some members of the Fed, some parts of the Fed staff, we happen to believe much better captures the business cycle. Household and corporate sector income is what drives spending and what drives investment. And that GDI measure, although there's some measurement problems with it, on balance is a much better indicator of the business cycle. There really wasn't much of a slowdown. And in fact, if you look at it year on year in nominal terms, GDI was up 14% in the third quarter. Corporate revenues were up 15%, right? We all knew that as equity investors, that there really wasn't much of a slowdown, whereas GDP was less than 10. So there wasn't much of a slowdown related to the Delta variant. And it appears to us, based upon how we think this is likely to unfold, that there won't be much of a slowdown associated with this either. Okay. If there is any economic reaction to all this, we think it'll be inflationary because of all the authoritarian countries out there in the world, including China, that will use this as another opportunity to clamp down on their population. They erroneously, in our view, believe that they could actually eradicate this virus, that they could somehow avoid it being endemic. We think that's been proven nonsense throughout the course of the last almost 2 years now. And but they could create I guess we'd call it an inflationary aftershock. And so if there is any economic impact from this, it's probably more inflationary than likely to slow growth. If that is indeed correct, if all of our logic stands to reason, that means we're going to be right back to a debate about the Fed accelerating the taper, either at the December FOMC meeting, or perhaps it gets pushed to January if there's enough uncertainty associated with this wave. Nonetheless, they are going to have to accelerate the taper. The inflationary pressures are growing. And when that happens, you'll likely have a pullback. Now, we commented many times, we thought when the Fed started the taper that was probably worth 10%. We only got 6. But if they accelerate the taper and liquidity conditions are likely to be far less generous in the first half of 2022 than they were in the first half of 2021, again, we could be vulnerable to a little bit of a setback. So from our perspective, you want to be in those reflationary sectors. If you want to use this weakness as an opportunity to add to risk, that's fine, but understand that we could be very well back into this discussion about the Fed accelerating the taper, in which case, we'd be vulnerable to a risk-off event. So it's a tricky spot from that perspective. A couple of extra or final points on all this. One is seasonality in the fourth quarter. We know it's part of the reason why the market was vulnerable to a shock. Lots of trader types were long. There was some degree of leverage undoubtedly in the markets. But you have to keep in mind the only time that you have negative returns in the fourth quarter, that the market really comes unglued late in the year, is when we're in recession or going into recession. And that includes 2018, when the Trump trade war was driving global manufacturing and trade into a recession. That's what explained the relentless yield curve flattening in 2019. That's what was going on. We were headed into a recession. Nothing of the kind is happening today. So it would be very unusual for the market to come completely unglued in this late in the year. So that seasonality factor, we know it's technical analysis, but it is strong, and we respect it. One final point, our measures of risk. That was in that note that went out to subscribers, the change in the VIX. And VIX relative to realized volatility, recent realized volatility. The VVIX, the vol-of-vol index, went to 140. That's another level that's pointed out to us that generally coincides with market lows. This was an extreme reaction, and that likely sets the market up for a pretty good bounce. Of course, as I'm recording this, the S&Ps are up 30 points, crude's up $3, and 10-year bond yields are up 6 basis points. So we're getting the bounce. We expect it to stick. If you get a window of opportunity to add to energy and financials in particular, that's to us what we think makes the most sense. We have preferred you did it on Friday. That's why we put the note out on Friday, to try and encourage that. So that's it for this week. We'll see what happens. I am scheduled to be on CNBC tomorrow on Kelly Evans' show. They haven't given me a precise time, somewhere between 1 and 3 p.m. Eastern. A couple of housekeeping items. We expect this week to release our 2022 Outlook note. The following week, we will release our thematic investing Outlook note. We do this same mixture every year. And then the week after that, we'll release our 2021 year in review note. So if you're not a subscriber, it'd be a great time to become one, because these are really our marquee reports of the year. We put a lot of thought and effort into them, and we generally think that they're pretty good. So that's it for me this week. Look for me on CNBC tomorrow. If there's any big updates that need to be had, we'll put out a note as timely as we can. Thank you. Have a good week, and happy Thanksgiving, everyone.